So let's go back to the bank statements on these what we call non-qualified mortgage loans for people who want to buy a primary residence. And this again, this can involve parents too. So for the bank statements, where we're going just based off of bank statements, these are the people who can qualify. Again, you see the non-occupant co-bars, that's parents. This would be like a parent who self-employed doesn't show all their income.
Yep. And B, I think a lot of people are going to ask, how do they qualify?
Yeah, so it's bank deposits. So and depending on the program, it could either be 12 or 24 months. Let's say somebody has $500,000 shown on their bank statement. They're going to divide that $500,000 by 60 months or 5 years. And whatever that number is, they're going to come up with a DTI that has to be under 50%. So this is the equation that they use.
Yeah, so normally what they'll do, like you said, is that they'll add up all eligible deposits. So again, in 12 months, if you have $12,000 of deposits, that's pretty low. But if in 12 months you have $12,000 and you divide that by 12 months, you're going to get about $1,000 of income. The one thing to note on this is they are going to hit you with what we call an expense factor, right? Because obviously, if your deposits are $12,000, I'm sure you're not netting all that $12,000 unless you can provide a CPA letter that your expense factor is pretty low. But like you said, it's pretty black and white. You show us your business or your personal bank statements, 12 months or 24 months, we add up the deposits, divide it by 12, hit it by an expense factor, and then the max debt to income ratio on these non-QM loans, depending on the bank, is absolutely usually 50%.
Yeah, and then that 12 to 24 months, it's going to come down to your credit score, and 700 is in general what you want to be. Could be six. Actually, this one you can go down to 620, which is amazing to me.
Yeah.
But I know you're probably the same as I am, and I think this is how we are as a company. We run the numbers. We're going to have a conversation because, like, just mentally, when I'm talking to a client, I will have the discussion. Is this a house that I want to take over? Meaning, do I want to be paying the mortgage payment if this person defaults? So if you have a 620 FICO, we're going to be having a conversation about like everything that's going on because I just don't want that hanging over my head that I was because even during the wild, wild west of the early 2000s, I was walking away from loans as much as it hurt. I was walking away from loans that if I didn't think they had the ability to repay.
I tried to do some pick-up pays and I could never get a client to bite on it. Like I tried to sell them honestly, and they just
Yeah, it's scary. It's scary. Now those pick up pays were, again, if somebody has a 740, 750 credit score, that implies that they're very good stewards of their money and they're going to understand it and they're going to make the extra payments that they need to make. We were lending to people in the 600s and it's like, yeah. And so I didn't have any of those hanging over me, but the only conversations I would have on the pick up pay or the I can't even remember the name of it, but you could either pay less than the principal, whatever.
yep.
That's for a very savvy buyer and investor. So these are some of the features of that program. Again, primary residences and second homes. And I put that ADUs in there again because I know in Pinellas County, there's just a ton of people that rent out their garage space or their loft space for people who want to come down and get some of that Florida sun. Was there anything from this slide that you wanted to add that I might have not mentioned?
Uh,
Again, no loan limit, 3.5 million.
yeah, no, I mean, I think you hit, some of the features here.